There are three major risks resulting from changes to international trade and exchange rates as outlined in Table 3.5. Transaction rates, where the exchange rate changes between the date on which a price is agreed and the date on which the payment for goods is made. This is a risk for both the exporter and the importer. Translation risk, an accounting risk relating to ownership of foreign assets which have to be converted into a home country valuation for reporting purpose, and these can result in paper profit or losses. Economic risk, where the viability of an international supply source can be affected by long-term currency movements. This can result in the supply source becoming uneconomic and another source may need to be identified in the long run. The following section will explain how exchange rates are determined, contracting options, and finally the role of the banking sector in international trade. Remember, there are three major risks in exchange rate change and are as follows: transaction risk, translation risk, and economic risk. Fixed and floating exchange rates. Exchange rates can be fixed, i.e. maintained at a certain rate, or they can float, which is where market forces are allowed to establish the equilibrium price. Demand and supply factors therefore decide the rate. The UK, USA, EU, and most other developed nations have a floating exchange rate. The rate is not decided by any government or central bank. It is determined on the money markets, which are the major financial exchange. The UK government attempted to fix the value of sterling within a narrow band in 1996. When the Euro project first started, the exchange rate mechanism, or ERM. The attempt to fix sterling proved unsustainable, and the UK subsequently had to instead allow the pound to float. The pound devalued by 17% over the next few months. Between 1994 and 2005, China effectively fixed its currency against the US dollar at 8.3 yuan to the dollar. Since this time, the yuan has been allowed to appreciate in value against the dollar, and is now maintained in a range determined by a basket of currencies. China is said to be operating managed floating exchange rate. A fixed exchange rate is where you have brought forward a quantity of currency which lasts for a set of period of time. A year, for example. You have certainty regarding what you pay during that time. If the floating exchange rate goes up, you gain. However, if the floating exchange rate is cheaper than your fixed rate, you will lose your money. It is about certainty of budgets and also managing the risk. Notes: Euro project. The attempt to integrate all currencies across Europe to the euro. Exchange rate mechanism, or ERM. This was set up to try and stabilize exchange rates across Europe. Manage floating exchange rate, an exchange rate that changes frequently. Central banks tend to intervene to try to prevent too much currency fluctuation.